Good morning, everyone. This is Joseph Trevisani from Worldwide Markets. Thank you for attending. I apologize for being a little bit late this morning. We have another snowstorm here. We're on some sort of schedule here in New York with snow. Every 4 days, we get another snowstorm. It's been going on for about a month now, similar to what it was last year. So it took me a little while to get into work, unexpectedly. As usual, when I hold these webinars, I prefer to think of them, you've probably heard this term from me before, as colloquiums. If anyone has any comments, criticisms, the usual plea for jokes, or any other input, please type it into the chat system. I'll be glad to take up the topic immediately as soon as I finish whatever I'm talking about at the moment. I think we all learn a lot more by bringing different perspectives to this webinar and all the other webinars. So that's what I would like you to do, and I thank you very much. Today's topic, what is the Fed going to do? It is about the only topic these days we have a new topic, and that's Greece, which I actually have a little bit in there, of importance here. The Fed is in unknown territory. We've all known this for a long time. There's nothing unusual about this particular analysis. But there is a serious question about what, one, the Fed will be doing. Two, if the Fed actually has a lot of clue as to what they're doing. My guess is they don't. Of course, they can't say that. And how will this play out? A good deal of this is speculation. Frankly, the least speculative part of what I'm going to talk about. Good question. Take it up immediately. Is there a scenario for more QE from the Fed instead of rate hike? Not in public, there isn't. But there are some commentators who will say that this will not work. The Fed has given no indications whatsoever that that's a possibility. Is it a possibility? Of course it is. The problem with the possibility is that QE doesn't really work very well. And if the Fed now, 6 months from now or a year from now, finds itself in a situation where more stimulus, the economic journalists out there and reporters who write about this are continually talking about this stuff as provide more stimulus. QE provides almost no stimulus. It has had remarkably little effect for the amount of effort involved. Now you can, I suppose, make a case that what the Fed's really doing is just buying up useless, well, treasuries aren't useless, but MBS certainly was, securities that will never, anyway, be useful. So they're just taking them off the market. But that's another topic. So let's take a look at. So no, there isn't any. And this one reason I think there is none in public anyway. And this one reason I think the ECB's current plans to buy debt is something the Fed must be extremely worried about. Not that they didn't want them to do it. There's comfort in company, as you know. But that is not going to be effective. If we look at No, that is exactly the same topic, and I'll tell you why. At least my opinion, of course. I don't know why. But let me just finish what I'm thinking about now, and then I'll start on that topic. And that's a good precursor topic as to what we're talking about. Why did, if my opinion is, and many others, I'm not the only one here, and I'm a trader by training and by career. I'm not an economist. So my viewpoint is a little different as to what's effective. I take from my signs of effectiveness not from theory, but from what the markets tell me. So the other as it's right there to view, but not shining from the fact that it worked, is the Japanese. The Japanese have been doing either some varied form of QE, although of course not named that, or endless deficit spending for 20 years. Let me show you where's my Japanese chart? Forgive me, my charts are a little, I know I have but I had a Japanese chart. I want to see if I had a, did I not put up that Japanese chart? Hold on, let me find my inflation chart here. Forgive me, folks. My charts are a little less organized than I would like them to be this morning. Okay. Unfortunately, I didn't put Japan on this chart. Okay. It's on the CB rate chart. Anyway, this is a chart of a European 10-year rates. Let's take a look at another chart here, and then I'll go back to your question about why the Fed does these things. Okay, this is a chart of central bank rates since 1985. There's something very peculiar about this period right here. We all know that. We've lived through it. Exciting period. May you live in interesting times, the Chinese stuff. The Chinese... I remember I started a paper in grad school once with May you live in interesting times and explaining how that was a Chinese curse. In fact, no one has been ever able to trace, and it's been used many times since then. I did not originate it. But in fact, no one's ever been able to trace it back to an actual Chinese text. Apparently it was made up sometime in the late 19th century by some Western commentator on China, and it's been quoted as a Chinese proverb or saying ever since, and it's not really, which I found fascinating. I once bought this book, which was very famous in its time in I believe, the 1910s, written by an Englishman, where he purported, quote, The Annals of the Imperial Court. And it was purported to be an inside story of what was going on in the court of the last Chinese emperor and empress. And in fact, he had made almost the whole thing up. And he was very famous for a while, and then he got discovered. Anyway, but it's a great book. It's like 400 pages thick. It's a great old book. And I have one of the originals because I found it fascinating they could get away with this. Okay. So let me find the Eurofin. I'm looking for the one that I have tied to inflation. This is the euro and the charts. All right. So I really do apologize for my slightly disordered charts this morning. It was a real struggle getting them over to this computer this morning. Sometimes I have my beefs with... Here we go. This is what I'm looking for. Sometimes I have my beefs with Microsoft. None of it is personal, though. Okay, here we go. One of the purposes... there are two purposes for quantitative easing. One is to support the economy. Two is to provide inflation. This is a chart of the ECB's rate, main refinancing rate, and inflation, CPI. The Europeans do headline CPI. Does anyone see any effect from cutting rates on inflation in Europe? There isn't any. None that's discernible from this chart, unless, of course, cutting rates lowers inflation. That seems to be, if you're just going to look at these two charts as looking for cause and effect, with no other input, no other considerations, you would say that lowering rates causes inflation to go down. Now, since we all refuse to believe that, at least as a causal effect, we start looking elsewhere. But just in the European situation, you have a chart which shows that. Now, I don't have the chart, but you have a similar effect in the U.S. I do have a U.S. CPI chart. Here we go. Okay. This is U.S. CPI. Year over year, top line yellow. I'm going to talk about this chart in a different context, but top line yellow. Okay. Now we know let me show you side by side with the QE, with a chart that actually gives you some QE analysis. Hold on. Okay, hang on a second. Okay, now I have another chart with a Dow chart with QE on. I just have to find it. Sorry, folks. You'll have to forgive me on this. I hope I have earned some leeway on this. Where is my Dow chart? It says INDU. I know I made the chart. It's such a cool chart, but I can't find it. And I do not want to go back to my desk and get it since I'm in a different room. Where's my my Dow chart? There's QE and Euro. Okay, this is sort of the same thing, but one has to improvise, so I'm going to improvise. Okay, now you can't see very well, but this is 2012. This is 2012. We're talking about QE started in the fall of 2011. Okay, over here. It ran through the middle of the end of 2012. Then we had QE. That's QE3. Sorry, that's QE3. Correct. Get confused with all these things. And the last QE ended in October, right here, and it went from here to about here. So you have the same type of cause and effect, which of course we don't believe, as you have here from the rates. The two purposes of quantitative easing are support the economy and pump up inflation. Neither one has particularly worked. Certainly, the effect on inflation seems to be opposite what's intended, which is why I do not think that European quantitative easing, which is going to be less extensive than the U.S. and much harder to administer because of the nature of the European Union and the divided bond markets there, national bond markets, I see very little chance that it will have any beneficial effect on Europe. Remember the great argument for quantitative easing and all the others, monetary finagling since the financial crash and the recession of 2008-2009 has been the counterfactual. Well, things would be worse if we hadn't done it. It's a great defense. I wish I could use that in so many circumstances. You know, next time I get a speeding ticket, well, it would have been worse had I not gone faster. That's not a very good analogy, I guess. I'm afraid. Okay, next question, and this is a very important question, and it gets to the limits, and it talks about, my answer talks about the limits of, if you will, in a grand sense, human action and human societies. Why does the Fed do QE, and why did the ECB do it if it really didn't work? First of all, they didn't know that the Fed didn't know that. It could have looked at Japan and they would have said, well, that really doesn't apply. We have a different system. The thing about QE, there are two reasons I think that the Fed was willing to do this. Three, maybe. The first is they had a mandate to support the economy. In the beginning, their interest in 2008 and 2009 and 2010, their interest was to support the economy. And so why do QE? Because they didn't have anything else to do. It sounds like a really simplistic answer for such a grand experiment, for one at the highest levels of government policy, enacted by we think, at any rate, it's certainly their public opinion, and they do their best to cultivate it, the best experts we have on the topic. The smartest people we know of, Ben Bernanke, in monetary policy. There wasn't a whole lot else they could do. And the third reason was that in monetarist theory, if you need to create inflation, then you increase the money supply. You have more dollars chasing fewer goods, and you get inflation. So those are the reasons the Fed did QE. They have a mandate to support the economy. They were told by monetarist theory that at least they'd get inflation out of it. And inflation has been viewed by the government, by the Fed and everybody else in the government, as a good thing. I have my doubts about that. And third, and maybe more important than anything else, there wasn't anything else that they could do. The Fed's levers are monetary policy and regulation. But regulation is diffuse, They don't regulate a lot of the economy. They have no input whatsoever in fiscal policy. They certainly can't affect cultural evolution, changing spending patterns. They certainly can't affect technological evolution, the net, and buying things from Amazon. The only thing that they really can do is change monetary policy. Quantitative easing is monetary policy. The fact that they called it something else is irrelevant. It's monetary policy. Its purpose was to drive down interest rates, which it did to support the economy. From the middle of 2012, I think, their concern was, this is European, come on, there we go. This is European inflation. Let's take a look at U.S. inflation, okay? Not as dramatic a fall, but here, at this point here, from the middle of 2014, but if you look back to 2011, this is a downward sloping line, year-on-year inflation. This is a downward sloping line. So I would say from probably maybe 2013 on, the Fed, yes, these are Bloomberg charts. The call letters of the charts, how to pull them up, are over here. AHEY, that's the actual title of the chart in Bloomberg. This is CPI year. So those are the charts. If anybody is interested in these particular charts, I will tell you. Just send me an email. I'll put my email up there at the end of the show. I said show at the end of the webinar, and I will tell you exactly what I'll send you these charts. They're very easy to transfer. They're all on my computer. Question: what about doing nothing and let the market recover by itself? That is a very good question, and the problem with it is twofold. The first one is they would never get away with it. The public pressure on the Fed to do something would have been insupportable. The Fed could never have sat back, Mr. Bernanke, in the fall of 2008 and said, you know what, this is the way markets work. We must let markets work. There's not a chance in anything that would have happened. Bureaucracies, people with power, like to act, even if it's not always the best thing. There's a saying for sometimes, from the markets with all their cliches, many times the best trade you made is the trade you didn't make. That could very easily be true here. Many things would be better off, in my own opinion, were they left a little more to themselves rather than the subject for all this endless government intervention. Okay, so from the fall of, I would say, 2013 on, the Fed is becoming increasingly concerned about inflation. Whatever you want to say about quantitative easing, whether the Fed should have done it, whatever effects it has not empirically changed U.S. inflation at all, except perhaps for the European relationship that quantitative easing and lower rates produces lower inflation, which is heresy to an economist, to monetarist theory. It is possible, and I certainly believe it is true, that there are other factors here that are simply not amenable to monetary policy. And those factors cannot be reached by monetary policy. They cannot be reached by negative interest rates. What kind of economic situation is looking to order itself by using negative interest rates as an incentive? It seems to me that at that extreme, there are other factors involved. There is no denying that empirically, as I said, at the very least, quantitative easing and zero interest rates or negative rates do not affect inflation in this situation. The only conclusion you can come to is that monetarist theory that says greater, very simple equation, greater dollars, greater euros chasing the same number of goods should produce inflation, does not operate in this situation. There's almost no other excuse. I mean, what you will get is what you get from the Fed. We expect some time frame. What do they say? I forget what their exactly time frame was. What they really mean is sooner or later, we hope inflation will pick up. Okay, but they've been saying the same thing for 4 years now, and there hasn't been any inflation. Inflation's going the other way. It is possible that there is an inadequacy in the economic theories that are applied here. That something as with all market equations, they operate on assumptions. That's why every computer-driven system, maybe except an algo system where they're just trying to take advantage of infinitesimal changes in prices, that attempts to predict market levels ends up failing. Why? Because at some point, the human animal behind the markets changes. The assumptions that operate in the theory cannot explain a changed world. An example. What's a recent example? We all lived through it a couple of weeks ago. The Swiss dropped their peg. We all have, I think, in the market have heard the story of what happened to FXCM. Now, FXCM was operating, for those of you who don't know, and I think you probably all do know, FXCM was the largest retail, they're not really a broker, they're a market maker. And there's a big difference between a broker and a market maker, but there's now not the time for it. So again, here we have an assumption. They did straight through processing. That means they simply acted as a go-between for and again, this is my conjecture on what happened. I'm pretty sure it's accurate, but I don't, of course, have memos from FXCM and Drew Nibb telling me this is what happened. But this is what I think happened. They ended up in a hole of $225 million. How did this happen if they're doing straight-through processing? The straight-through processing means none of the trades are on their books. What happened is this, in my analysis. What they did is they hedged their book. So if they're long 50 million euro on their books from the customers all sold them euro, then they went and sold 50 million euro in the market. So there are two positions here which counterbalance each other. A long position from their customers and a short position in the market. The market moved that. The assumption on that is that they're hedged. And they are hedged in normal markets. Prices moved so quickly, 3,500 points in about 20 minutes, if I remember. I remember did an analysis of it. That what happened? Well, all of the customers who had their positions on the books with FXCM were all margined out. They were margined out way beyond their equity because there were no prices. So what happened on the other side of the hedge that they had out in the market with, I don't know who they had it with, whatever bank or trading house they had it with. Same thing happened. They couldn't get out of the position. The assumption that the market would have prices is where that faltered. It's the same thing that happened in the financial crisis with all the MBS and CDS and all that fancy financial engineering that was done. Many of those instruments were on the bank's book at valuation mark to market. That means the banks had to set capital aside based on the valuations from the market, giving them how much this particular instrument is worth. Well, there were no prices because the prices in markets are voluntary. If nobody puts in a price because they don't know where the market is, there is no price. I mean, the EBS and Reuters platforms that are the basis of FX pricing are, I'm sure you all know, but for those of you who don't, I'll tell you quickly. They're terminals that sit on traders' desks. They used to sit on my desk when I was trading for the various banks that I worked for, actually just two. Credit Suisse, which is still in business, a big Swiss bank, one of the three universal Swiss banks. Good people to work for. I thought they were very, well, that's an irrelevancy, so it doesn't matter. You sit at the terminal, you put in prices. You back them up against your orders. You might be speculating, whatever. There's a whole, it's like a NASDAQ level 2. There are scores of prices going up and down from wherever the market is. And they're voluntary. I have a price in there to buy, say I'm a trader, to buy 25 million euro at a particular level, probably because there's a customer behind it. Well, when that happened, everybody pulled their prices. There were no prices. So the operation of assumptions behind, not just behind computer-driven programs, behind the assumption of a protective hedge, and behind economic theory are where all of these items or these ways of analyzing the markets and the market world, if you will, fall down. The assumptions change. Something, in my view, has changed behind the assumption, the equation, the tight relationship between inflation and the money supply. Now, there is an example of this out there if anybody wanted to look at, but nobody, of course, did. One thing we are all reluctant to do is to give up our own assumptions that order our view of the world. And that is as true of Fed governors and academics and Ben Bernanke as everybody else. Maybe more so, because they have more responsibility than I do, and more responsibility than we do. Mr. Bernanke, of course, is carrying the weight of the U.S. economy on his shoulder. I'm sure he was kind of glad to get out of that. So the assumption has proven, at least so far, to be inaccurate. So where could they have looked for a disquieting notion that maybe there are other factors here that may actually be more important? And of course, the shining example, which no one bothers to check, they just dismiss it, is Japan. Japan's been doing various versions of this kind of stuff for 20 years. It has not produced economic growth. It has not produced inflation. Endless deficit spending, which is the same, if you will, as quantitative easing. You're just counting it differently. You pump money out into the economy. You sell bonds. You pump money out into the economy. You build bridges. You build subway stations. You build God knows what. Not produce any appreciable inflation in Japan. Something, and of course, the reason banks do QE because they have there's nothing else they can do. That's the basic reason. They have to do something. They have a mandate to take care of the economy. They have to do something, and there's nothing else they can do. I mean, it's kind of that simple. It sounds very programmatic. It sounds almost very childish. And I don't mean that these are childish people. I don't. From all my personal experience with many government officials and others is that these are very bright people and dedicated people. And I am not meaning this in any sense as criticism of either the motives or the activity of central bankers around the world and what their purposes are. The Fed does, in fact, want to improve the U.S. economy. The Bank of Japan does. Prime Minister Abe does. Barack Obama does. Angela Merkel does. Alexis Tsipras does. But from intention to results, it's a long and hazardous trail, as we have seen. Okay, so the Fed knows this. It is not something they're going to talk about in public. But these are bright people. Is it possible that they will stick to their theories and refuse to let evidence enter in? The Fed has been saying the same thing for 4 years now. Well, 3 years, 2.5 years. Inflation's we're going to get inflation sooner or later. We're going to get inflation. I say sooner or later. We expect that inflation will return, will return to its 2% target in whatever period they put in. I've been saying this for 3 years. It hasn't done it. In fact, it's gone the other way. Now, I deliberately chose headline inflation rather than the Fed's core inflation, because I personally don't think that core inflation is a worthwhile concept. It is one which simply lets the Fed say, you know what, the underlying trend hasn't changed. I don't believe that. I think that the volatility is one of the things that in itself affects long-term trends. However, I have not written that up. Okay, so let us continue. The Fed has been hinting. So the background of Fed policy we just went through, and central banks and everything else. So the primary consideration for the Fed is, of course, the U.S. economy. I'll deal with that in a second. Let me just take a look at, and then the first thing the Fed has been talking about has been, of course, whoops, what happened here? U.S. unemployment. Okay, let me have a better chart than that. It's not that one. As I say, my charts are a little disorganized this morning. Okay, let's go with this. This is the Fed funds rate. What's on this one? No, that's not the one we want. Forgive me for this, folks. Okay. And I have another one. Where's my one with QE and the... That's not it. GDP. I have a great one with... I better have that one here. With QE and the euro. That's not it. Where's this chart? Where's my chart? Sorry, folks. I feel a bit childish here this morning because I don't have what I want as organized as I want it to be. But I will find them. What happened is I just got here late and I had to send the charts in, and so I don't have them grouped as I would like them, so I know where everything is. And that's why we're doing this. I hope it's a bit of a tour. You know, I'm going to do this in a very organized fashion. So we know, and if I don't find it, I'm just going to have to skip it. But I have this great chart that shows QE, and we could use this one as well, and I will if I don't find it, along with the U.S. All right, I'm boring everybody enough with this, I think. Where is this chart? With well, my frustration is much greater than yours at the moment, despite my bad look at the charts here. Did I not send this chart? It's the greatest chart. It's not even cute like that one. Ah, here it is. It's over here in the corner. Boy, do I feel silly. Here it is. Okay. This is one of the effects of QE. QE 1, 2, and 3, along with the Fed funds rate. So, as we were saying earlier, the Fed funds rate has had very little effect on the economy. It's had even less effect, or perhaps a counterintuitive effect, on inflation. The Fed pumps money out. The ECB is about to pump money out. Japan's been pumping money out for 20 years, and what happens? Inflation either goes down or does nothing. There seems to be a gap in the theory. And I can tell you what I think it is, but it's very now. But I will later, okay? One place it has had an effect, and the Fed intended this. The Europeans intend this. The Japanese intend it. The wealth effect, the famous wealth effect. All this money goes out in the economy. It's got to go somewhere. We have our kids' college money out there, right? And so my wife goes, well, we're not going to be using it for this many years. What do we do with it? We actually have money for their school, which is going to go out, which has to go out every year. We pay a certain amount for their school. And so we have a 3 or 4 year, we have like a 5-year horizon on this money. We know we need a certain amount of it each year. And so Liz, who was an ex-investment banker, my wife, says we got to invest this in something. And then the question comes back from me, what? We know next year we're going to need a certain amount of money to pay for school. Where do we put it? Well, there's no place to put it. And I'm very wary, although it has been incorrect, of putting it in the market because I'm perennially expecting a crash. Well, we haven't gotten it so far, and I've been wrong. But I don't comment on the market very much, luckily. This is one of the effects of quantitative easing. Of course, it pumps up the market. There is nothing in this chart that relates to economic fundamentals in the United States as far as the economy being reflected in the rising value of the stock market. Nothing. Not nothing. Very little. It has done wonders for stock prices. It is the Fed's, well, they don't talk about it much anymore. Bernanke used to talk about it, the wealth effect. So we know that it can have some effect. However, the wealth effect, its purpose is not to make everyone wealthier. That's not the purpose, supposedly anyway. The purpose is to make people spend money and support the economy, especially in the United States where it's 70%. You all heard that 100 times a day practically. Buy things and support economic growth. There's a very tenuous connection there. There is probably some. It's almost impossible to prove. So the Fed, again, as with its entire policy, could simply say things would have been worse had we not done this. Okay. So let us turn on to the topic. There are some questions. I can't really answer the current account balance question. It's beyond the scope of what I want to talk about. Maybe I should do something on trade policy. I haven't done that in a while. I have actually done that. Okay, so the Fed's considerations are U.S. economic. That's what the Fed's concerned about. So let's take it from there are 3 areas, I think, that the Fed is judging as far as when they're going to raise rates. The first is the U.S. economy. The second, I think, is, and where is the U.S. economy? The second is they now know, I think, how artificial an environment, economic environment, is created by 6 years of zero interest rates and endless quantitative easing. They suspect, although they can't prove, that it is hugely distorting to the economy, but they're not going to admit it in public. Okay? So I think that's the second reason. The third thing they're concerned about, of course, is the state of the world economy. So let's take these one at a time. Okay? The U.S. economy. And as part of the second one, they can also say how much of the U.S. economy is real. That means self-sustaining growth. And how much is simply enabled by the lower rates. They don't know. Nobody knows. We've never done this before. But on the basis of U.S. economic statistics, let's take a look. The Fed has some comfort. Okay, we have unemployment rates. This is the U6 rate. This is the U3 rate. The U3 is, you have to have looked for a job in the prior month, which I think is a very false way of looking at the unemployment rate. This is the U6 rate if you've looked for a job in a year or you are working part-time and want to work full-time. This is a much more accurate depiction, but this is the one they talk about. Okay, but they're both out there. So based on that, we've got a reasonable, I had to focus here, a reasonable result. The Fed is going to say this is because of our policy, but whatever it is, the unemployment rate is down to 5.7 by the rate that they like to talk about. Okay, so they're good with that. This is factory orders, not an unreasonable. We can talk about this here in a minute. But again, a reasonable period. This is some sort of statistical anomaly. I don't know what they were doing with that. They were up 10% and then down 10%. That's talk to the Bureau of Labor Statistics. I don't know what they're up to on that one. Okay, this is non-farm payrolls, the one that we keep talking about, and average hourly earnings. So non-farm payrolls has given everyone a feel good. It's gotten better. There is an upward slope here. It has recovered. Okay? Average hourly earnings has not. You can say what you want about it. The fact that the last month had a boost of 5%, a 0.5%. As you can see, those kind of improvements have happened before throughout this period. There is no trend here. So, all right, let me take that back. There is a slight improvement from here to here. Okay, a slight improvement. But there's no sense that this is a rising trend. There's nothing historical about this. If you look at the average increase year on year here throughout this period, it's between 2 and 2.2%. Go back, and I didn't run this back 30 years, but I could have. You take a look here. The historical improvement is somewhere between 3 and 4%. That's the historical rate of improvement. Look at this chart. This is, where is it? Okay. This is average hourly earnings. Remember, this is the Fed's latest concern. I'll get to some of these questions. I apologize, but I wanted to get through some of what I have here. So, because after all, you all came to this webinar for a particular topic, which I would like to cover. So as much as I love answering questions and getting off on all the tangents that fascinate me, and I hope everyone else, I want to finish the topic too, the best I can. I have a tendency to run over, as everyone who comes to my webinars knows. Anyway, so this green line down here is average hourly earnings year to year minus CPI. This is the improvement in cash, if you will, that's available. Now they don't look at exactly the same set of criteria, but I use it as an approximation. Real disposable income is actually a better, I think, but it's a narrower thing, so I don't use it. But I could use that as well. And you get a similar type of chart. Because remember, whatever you get as an improvement in your wages, there's inflation that retracts from that. So the improvement of this, I should have run this back 30 years, is below 2%. It's not even 1.5% every year. There is nothing in this chart that's going to make people go out, buy new houses, and do all sorts of things that would get the economy moving. Okay, so on the economic front, the trend, the absolutes have improved. The trend is not strongly higher. This is non-farm payroll over 30 years. You can see that there's a reasonable return here. The problem, of course, is that this gap, this loss here, is steeper than anything we'd experienced going back, I think, to the Depression, which is what everyone said. And a statistic that I don't have, which is the labor force participation rate, which is at a 30-year low. It means people are simply not working. They're not looking for jobs, so they're not being counted. Okay. This is the ISM. Manufacturing ISM. Manufacturing statistics are used as a precursor, a lead-in, if you will, for the economy, because the lead times for manufacturing processes are longer than they are for the service side. So even though the U.S. economy is maybe 85% service and 15% manufacturing, you get a better sense of of longer planning lead times from manufacturing. So the U.S. economy, based on these charts, not concerning the very end, which I'm going to talk about at the end, has been performing better than any other economy in the world at the moment. That's certainly any developed economy. There's no saying that's not true. It is true. But all of the statistics do not show any type of overheating, certainly on the inflation side. Where's that inflation statistic right here? This is inflation right here, the yellow line, the year-on-year inflation. Do not show any of the trends that the Fed would normally use to indicate a potentially overheating economy, a potentially rising inflation rate that they want to forestall. After all, that's the purpose of raising rates. That's the purpose of the rate cycle intersecting with the business cycle. It's counter-cyclical. When things start to go down, you lower rates. When things start to hot up, you increase rates. It's counter-cyclical. Its purpose is to smooth out the business cycle. And none of the indicators tell me that anything like this is happening. If you're looking and you're worried about inflation, what about this chart tells you you're worried about inflation? I don't see it. In addition, we had oil at $100 a barrel. It's now down around $50. Oil is the basic industrial commodity. The reason it's down are twofold: supply and demand. Okay, that sounds funny. Because there's more oil, because we're pumping tons of oil in the United States. That's why it's down. That's a permanent situation, meaning as long as the shale oil producers in the United States can make money, they're going to pump oil. What's also true, technology improves. The cost per barrel of shale oil is only going to go one way, and that's down. So it is, unless OPEC decides to start restricting prices, particularly supply, the price of oil is going to stay well below what it was before. Well, that affects the entire economy because oil and energy is the basic industrial commodity. You want to make anything, you need energy. You need a manufacturing process, you need energy to run it. Whatever it is. You're making toothpaste, you're making thread, you're making cars. You need energy. You need electricity, generated mostly from oil and coal. So anyway, there's nothing about that chart that tells me the Fed has anything to be concerned about inflation. Of course, they're saying they need to do it because they want to raise rates, and I think they do. So, and even from the employment and energy and earnings side, there's very little in the U.S. statistics that show any acceleration that needs to be restrained by interest rates. Okay, so we can say that although the Fed has cited the economy, I'm not buying it, but that's part of their mandate. They've got to say that. Second area, they want to and they keep talking about this normalizing rates, which I think is a key to actual Fed policy and why I think they probably are going to raise rates, but I'll talk about how in a minute. The normalizing rates, that's what they keep saying. Well, what do they mean? Are they talking about historical levels? No. But they are talking about something other than what they have now. What is their concern with normal rates? Why do rates have to be higher? The reason, I think, although the Fed is not going to come out and say that, they have given hints of it quite a few times. Their concern is that, remember, prices are what allocate resources in a capitalist economy. which is the world, despite what the Cubans say, and the Vietnamese, and the Chinese. No, the Chinese are capitalist. Anyway, well, money also has a price. It's the interest rate. I remember there's a quote, I think, from Warren Harding, I'm not sure, one of the American presidents in the 20s, talking about were the Europeans going to repay all the money we had lent them during the First World War. And somebody said, or maybe it was specifically in relation to Germany, I'm not sure, it might have been in relation to France, I'm not sure. And somebody said, well, they can't really afford to pay it back. And his return was, whoever the president was, I think it was Harding, but I'm not sure, it might have been Coolidge. Well, they hired the money, didn't they? That idea of hiring the money is what I'm talking about. The artificially low rates for 6 years has created, I think, an enormous misallocation of resources. Some of it's in the stock market we looked at before. The Fed has to be kind of worried about what happens when they finally start raising rates. They got to be worried about it. They haven't been worried about it so far. One of the reasons they're not worried about it so far, and one reason it hasn't had any effect, is because rates have continued to go down. Let's look at the 10-year here. I have the 10 years. Okay, where are my 10 years? These are European 10-year rates. Okay, I don't actually have do I have U.S.? I don't have U.S. 10-year rates on this, but you can get the same effect. U.S. 10-year, the U.S. 10-year is about 1.9. And this will get us right to the last topic I'm talking about as well. So the Fed's other concern, their second concern about low interest rates, is the economy makes decisions in relation to interest rates. It's a major cost of almost every business. Businesses work on borrowing money and credit lines. Their second major cost, in many cases, not all cases, but certainly in the service industries, is hiring the money. The first one is employees' salaries and wages and benefits. The second one is hiring the money. So we now have 6 years of artificially low rates. So many of the decisions that have been made are of questionable economic value, meaning they may not work. And the Fed's, I think, very concerned about this, and that's why they keep talking about normalizing rates. Okay, last topic, and then I'm going to talk about what the Fed has been saying, and then we'll end up. The last topic is, and again, you can see from here that nothing on these rates tells you that the economy is doing better. I just don't think it is. It is doing better, but there's nothing there that the Fed needs to worry about as far as making sure that they have a counter-cyclical policy. Okay, let's take a look at factory orders here. We could take a look at ISM. Come on, computer. Okay, come on, computer. There we go. Okay, ISM. Now, the last topic is for the Fed is, which I think they're going to ignore largely, is what's the effect of the world on the U.S. economy? The U.S. economy is not quite autarkic. That's a great word. It means it doesn't really interact with the rest of the world. That's not true at all. It probably does it less than many of the European economies. It certainly does it less than the German economy, which is 50% export-based, more or less. So when the Germans and other European exporters have been lending money to the Greeks and everybody else, part of it is self-serving, of course. It lets the Greeks and everyone else buy German products. There is no Greek car, and so many people in Athens drive Mercedes and other German cars. At any rate, and lots of English, other cars too. So the effect of the rest of the world is another question that the Fed has to concern itself with. We looked at the European rates a few minutes ago. Those rates indicate moribund economies. We all know that's true. The European inflation is down. They're entering into deflation. Their growth seems incredibly stymied. Yes, Germany looks good, but as soon as, and it doesn't look good, it just looks better. As soon as the rest of the Europeans stop buying goods, who do they stop buying goods from? Germany. Half of their exports, I believe, go to the rest of the EMU. So this has to be part of the Fed's considerations, and it is starting to show up in the manufacturing statistics from the United States. This is ISM. It's not below 50 yet, but it's headed down, and it's now a bit of a trend. It's not the only trend. Factory orders as well is showing in the same time frame a drop-off. So this has to be worrying to the Fed. Is it going to affect the Fed decision? I think not. Okay, so now we have the three indications, three areas that the Fed is looking at. I have the U.S. economy, which is doing much better, but has two problems. One, there's nothing in the economy that is showing the need for countercyclical policy. Two, there are serious questions coming to the fore now about the impact of the slowdown in the rest of the world, including China. I didn't have time to get to China, but I have some stuff on China here, on the U.S. The U.S. does not live in an island. We may have a continent, but we are not alone. So the last question is, will the Fed take its need to normalize, which is a nebulous concept related to stuff they don't want to talk about, although they have spoken about it on occasion. The misallocation of economic resources caused by the artificial cost of money, the artificial return on money, artificial returns for banks. Why would the banks want to lend now when they get such low returns and they can do far better by getting free money and investing it in treasury, all sorts of treasuries? There isn't going to be any real effort for the banks to get business. So the only thing that seems to be pointing towards a Fed increase in the summer is the need and the desire. I think the Fed's getting concerned that if they don't start ending this policy and things get worse, how are they going to? In other words, if the U.S., they may have a moment now for the next couple of months, next 6 or 8 months, where the U.S. economy is doing well enough so that they can plausibly justify raising the interest rates. But what happens if Greece does come and leave the euro? If you get great amounts of turmoil in the world and that starts to come back and affect the U.S., how will the Fed justify raising rates if job growth starts to fall off, if all of the indicators start to fall off, and average hourly earnings and other wage statistics start to drop off again? The Fed will not be able to raise rates in those conditions, period. Then when do they raise rates? On top of that, if things get worse, what do they do with QE? They start up again. So they're looking at a very tenuous window here as to where they will start to raise rates. Even if they do start to raise rates, say in June, they're so far from anything like a normal rate environment that it almost seems like there isn't any purpose to raising rates, that it's not really the level of the rates they're talking about, just what they're trying to indicate, that this is going to happen. Okay, last topic, and then we will end. That's a good question. I will answer you that. The trouble is, for me to say what I would do, I'd have to say what I wouldn't have done, which begging the question a little bit. I will take it exactly on the level that you're asking the question now. Somebody put me in charge of the Fed, what would I do? Okay, the last thing we look at is indicators. It's actually comments from the Fed, and I'm doing this from memory here. When Janet Yellen was her first news conference in, what was that, March of 2014, when she said basically the result was we could start raising rates 6 months after the end of QE, which brings us right to the middle of the year. We've been on that date as the first possible indication that first possible incident of the Fed raising rates ever since. Mr. Bullard who is he? No, he's not Fed. I forget where he's from. I apologize. And he's not a voting member this time, but he's very close, it's apparently, to Chairman Yellen and other comments. That's true. His latest statements, I think, are probably the most telling for what the Fed is trying to do. It is that the markets are not taking basically said the markets are not taking the Fed's indications that they're going to start raising rates seriously. If he says that, I think they're going to start raising rates. How and why? I think there are two reasons. There are two things that are going to happen. One, sometime in the third quarter, I think the Fed probably is going to raise rates. And the reason is psychological. It's not economic. There's nothing in the economy that indicates you need to raise rates. Based on its standard criteria of an overheating economy, wage inflation leading to regular inflation, or regular inflation leading to price inflation leading to wage inflation. There's nothing out there like that. But the Fed is trying to get the markets off the elixir, the sugar of low rates. Now remember, if the Fed can convince the markets that this is where, the credit markets, that this is where we're going, then the credit markets will do the work and the Fed won't have to. The Fed won't have to raise the Fed funds rates to 2 or 2.5%, because market rates are not keyed on the Fed funds, they're keyed on 10-year and other rates. So if the Fed can convince the markets that it intends to do this, and I think this is what it's trying to do, to get the markets to move without the Fed. The other and last and final reason, I think, and this ties into the chart you're looking at here, I don't believe that the Fed or anyone else's confidence in the world economy can at all be such that there's not concern and worry about another recession on the near horizon. Near horizon, I mean within a couple of years. I'll say 2 years. Well, if Fed is stuck at 0.25 and we get another recession, what are they going to do? So the Fed needs to start moving so that it has some sort of leeway to employ its traditional rate tools whenever there is another recession. And you know what? There is going to be another recession. So from the Fed's point of view, even though there's no economic reason, they are forestalling nothing. There are good reasons to at least start a rate cycle. And I think that will end up being what they're doing. Because in fact, and I think they're trying to tell the markets, look, we move 0.25%. It doesn't matter economically. It doesn't. If the Fed funds rate is 0.25 or the Fed runs target to upper bound of the target rate is 0.5, does that make any difference? Almost none. What does matter is the sense of a return to normality and a market that will move and bring rates to a higher level. So what can we look for? I've moved to the camp, and this is relatively recent for me, that the Fed is going to do some sort of move sometime in the third quarter. You know what I also think they're going to do? Almost nothing else. It's going to be the slowest imaginable rate cycle. Because the Fed starts looking at, here, look at this 30, where's my CB rates? Okay? Look at this cutting. And before this, if I'd gone back earlier, do I have a 30-year rate chart here? And we will end with this. Yes, here we go. Okay. This is the Fed funds 30-year chart. Take a look at this. This is the standard type of Fed rate hike cycle. This. It's relatively steep. That is exactly what the Fed is not going to do. It is not going to move from here, which is about 1.5%, to here, which is 5% in that kind of time frame. It's not going to do it. So I think what we're looking at is a indicative move more than an actual rate cycle. Okay, let me look at some of these comments here. I thank you all for waiting. I hope it's been reasonably interesting. I will wrap up. Yes, I am afraid I do feel that there is going to be another recession sometime soon. The reason is because the U.S. does not live on an island, and the rest of the world has problems that are not amenable to being addressed by the tools that central bankers have used. For one, they're out of tools, and two, they don't address the problems. Okay, friends, I thank you very much for attending. I will put my email address up there. If anyone would like the charts or anything else, any comments, questions, or anything else, please send them to me. I will be glad to answer your questions and engage in any type of dialogue you would like. Let's see if I spelt that right. It's J. Trevisani, actually. That's my first name. It's Joseph. At Worldwide Markets, there should be no space there. Oops, that's an M. Okay, worldwidemarkets.com. Again, thank you all for attending. I take it as a great compliment that people take time from their day to listen to what I have to say. I hope this has been both instructive, illuminating perhaps, and maybe a little bit entertaining. I'm not so good on the last, but I do thank you all for attending, and we will see you again in about 2 weeks. And I'd like to thank FX Street, Adinda, and everyone there for making these webinars possible. Again, thank you, and everyone have a great day.